Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here. So in this Options Guide TV, we're just going to look at, we're just going to review positions that we have already put on and already talked about. We had a lot happen with the geopolitical concerns over in Israel. And that's what's really driving the markets at this point in time, more so than inflation or even potentially jobs. But jobs are still the focus as far as the economy is concerned. Wages, job growth, potential layoffs. That's where the economy is focused. Everybody else in the world is thinking about the geopolitical concerns that are going on. We're seeing a jump up in most energy stocks today because of the concerns of what might be going on in the oil fields. That's straightforward. So we saw ExxonMobil make a strong move to the upside this morning, and we actually talked about a hedge last week on the trade. Now, I would have already been out of that trade because the market did open up higher and the trade was profitable. But I want to show you that trade because very rare do we get the opportunity to teach as much as we did this week, in that we put on trades on Monday and the market has moved since Monday. So there's an opportunity to talk about the adjustment that we made to the XOM trade, which is ExxonMobil, and also look at the VIX trade. So once again, we looked at a butterfly at the end of October, and honestly, just gotten lucky with these trades, to be blunt, because well, I mean, there's a little bit of seasonality behind it. We're looking at managing risk by doing a butterfly, putting a trade on that way with not a lot of exposure because we're not going to pay a lot for the trade. But we did a trade at the end of August, and the beginning of September, the market tanked. We did one at the end of September. The market kind of leveled out thanks to the Fed, and the 50 basis point cut is really what leveled the market out in September. And then at the end of September, we got long the VIX again, and guess what? The market, well, it didn't necessarily tank, but volatility definitely has risen since we hit October, and we're only on October 2nd. So that's where we're at. So those are the trades that we're going to look at today, and we'll be fairly short and sweet. And I do anticipate if you have some questions, please do put them in the chat box. If you're in the Tradier hub, you can ask questions directly, or if you are on the YouTube channel, the Tradier YouTube channel, both of them you have to be signed in order to ask any questions directly. But I'd like, if you participate in my reindeer games, I don't have any problem with that. So let's get to it. Let's pull up 1 second here. Let's pull up. There we are. We already are in the Tradier Pro. Okay. So ExxonMobil. If you looked at the chart in ExxonMobil, which I hope it pops up right away, we saw a real strong. I still really like. Oh, that's not ExxonMobil. XOM. I still really like the trade that we had on. Okay, so there was a little bit of a resistance area down in this range, and ExxonMobil actually went down. It got all the way down to 111. I didn't know that. I thought it was 113 or so, but so we came all the way down. It looked like we touched on that 200-day moving average when we put the trade on. So there was chances to get out of the trade. It wouldn't have been trading for, normally I would close around a dime if I did a trade, but on the ExxonMobil trade, well, we did it for a decent net credit to the account. I probably wouldn't have closed it. These are all on a paper trading basis. But what was really interesting is this 120 level. So how many times, okay, it broke through with a gap down all the way back in April, came up, and this dotted line right here is 120. Touched it, went back down every single time and traded right within that range. Now we're at 121. If we close above 120, as far as the chart is concerned and the technical analysis, and I'll zoom in this area, That would be a real good thing. We're at 121. We were even higher today. I think I can't quite. Let me zoom in on the chart. Yeah, we got to 120, 122.59. Now, I would have been out on the open if I had that adjustment that we talked about on Monday, where we had a short spread and we bought an option contract to turn it into a ratio spread. We used the credit from the initial trade that we put on and bought an option that was trading for very close to that initial credit. And that made it a 1x2. So if I'm highlighting this and we're still in the pro, this is one contract and that's two contracts. So I'm going to run, let's back out a little bit here. And I'm going to switch it up a little. Yeah, so I can do that. And we did a back spread. So what ends up happening in this trade, I'm going to stop it. Let's stay right here. Stay right here. Okay. Options playbook. Here we go. So this is my book, the Options Playbook. And when you first do a short spread, right, you ignore this line. But what a short spread does is you bring in a small net credit. And if the market goes down, especially with call options, if your market goes down, you receive that next net credit, and that's the maximum that you receive. The market continues on up from this point to this point. Well, that's our max risk. And then the line would continue this direction, right? It would continue this direction and we'd be at our max loss. So in here, in the back spread with calls, otherwise known as a ratio back spread, we're going to sell a call at strike A and buy two at strike B. So now if the market goes down and then skyrockets up in this scenario, you are long an extra option contract. So it doesn't help if the market just hangs here, but I'm going to hit my little graphic that I have going on. I'm going to adjust these a little bit, but this will be helpful right here. And I'm going to pause it right away. Okay, so to start with, when you do this trade, and let's let it run through one more time. Okay, when you put this trade on to start with, and it's a little bit better than this. This is, if you were using a real what if calculator, you would see it a little bit more. But when you first put on a back spread with calls, to start with, you're almost profitable anywhere on this trade. As long as volatility stays high and you don't let time decay erode on you too much, there's not that many areas where you actually lose on the trade. So what's really important is that you manage the trade based off of the days to expiration. So we started by just selling one and buying one, and we were fine. It came all the way up to here. I still really thought that I still kind of feel like the 120 level is going to be really tough for ExxonMobil to close above. Gosh, it'll be up 5% in 2 days, which is a big move in a energy company in general. But it's, oil is a big thing. Geopolitical concerns are something that can generate that type of movement in energy companies, and that's what we got going on. And so when we get to this level right here, we bought this extra call. So if the market goes up, we want to get out, because basically our trade was, we don't want the cheese anymore. Just let us out of the trap. We put the position on. We were down on the position. We used the net credit that we did on the trade to buy an extra call. And then the market did break out to the 122 level on the open. At that point in time, I would have been able to sell this for a decent net credit. The entire gaggle of securities was probably trading for a 50-cent net credit. So that's fine. We went to a losing trade to a winning trade, would have closed it and just got out of the trade. Let's see where it's at right now, though. So we'll go back and let's move back out a little bit again and pull this up. We're going to go to the what if calculator and get situated. Okay. So this shows you what you kind of saw in the profit and loss calculator. Now, this is as of today and today's pricing, but you see what I mean? You initially put on this trade on the way down. I mean, there's not a ton of upside unless you get more than a 1 standard deviation move, which would be all the way up to here. But there's not a lot of risk when you put the trade on. And we bought that extra option contract. Well, we talked about it on Monday. Okay, so now the market has gone in this direction. And this was, if you flip the script, you could go in, you'd be, if you would have put the trade on, we would have been at even. And now if we buy this, oh, I'm not in the right one there. That makes sense. Okay, so let's send this to the trade ticket and let's go back to the trading page. All right. So sell 1 by 2, 84-cent net credit to the account. So now it's at an 84-cent net debit. So if we could have gotten out a little bit earlier on the trade, because now we're at 121, we're quite a bit lower. The delta is 380 on this position. Every dollar that it's going to go up, it's going to add 380 to the total position on the account. So right now it's not looking as good. We need it to move to 122 or 123 to get to a point where it's going to be worth closing out. Right now we're down 84 cents on the trade, which is about what we were down if we would have just closed out the trade last week. Well, we'll see it on Friday, and we'll see where we end up closing at. Now, if the market goes down below 120, the market closes anywhere in this range, well, we're just at break even. We received a net credit for putting on the initial spread, and then we use that net credit to go out and buy another option contract. So our debits and credits have canceled each other out. And the initial net credit that we put it on for was 61 cents. Right now, if we closed it out, we're looking at 84 cents to close it out. And that's what our cost would be to close this entire trade. So we would be down 23 cents on this trade because we're buying to close and selling to close. Yep. We'd be down about 23 cents on the trade if we just closed it out right now. That would be an acceptable loss on this trade. The maximum risk that we've had from the very beginning is 5 points. Now we're bullish on the trade. We want the market to go up. It did this morning. We might have been able to get out at even, very close to it, if we would have watched it this morning. And that is our goal here, is we want to at least break even. And if we make a little bit, that's all right. This is our hedge on this trade. So we need the market to go to 122 or 123 or close below 120. It can't hang in this range, because if we go back to the what if calculator and we look at it, this is where we're at right now. But every day that goes by, and I can do that with this little thing. So then we go to Thursday, and that gets a little bit scarier all the way out, because we're done on November 25th. So let's go all the way out to this Friday, the 18th, and watch this line start to drop then. Now we're scary on this trade, right? Because now we're within that range and time decay is really hurting. So no matter what, by next week at this time, we're probably going to be out of this trade. We got about 7 more days before we want to exit this trade. If we go till Friday, a little bit, we really get hit if we do this last week right through here, the 15th, 16th, 17th, 18th, and then we close eventually on the 25th. So we definitely want to be out by this date, right? Or we need the market to just take off and go above the 125 level. All right, that was the trade. That's straightforward. Do we have any questions on that? And I'm happy to explain it more. I don't know if anybody actually did the adjustment on the trade, but if you did, hats off, because right now it looks like that was the right thing to do. I still think 120 just from the chart is going to be a tough area for this underlying stock. If it stays above 120, then that's some momentum. Then you could see it getting all the way up to this high right here, which is the all-time high of 123.63. So I definitely, if I get up towards that range, I definitely want to close it out, right? I don't want to try to break through two supports up at 123.63. That's straightforward. Okay, now let's go back to the what if calculator and let's look at our VIX trade. So the VIX right now is, well, it's coming down a little bit. It's at 1868, but more importantly, the futures contracts are kind of holding their own. So this is the trade. I'm going to add it to the trade ticket. So it's going to go down here. So I got the trade all set up in the what if calculator, and I hit send a ticket. Now we have it here. It's now trading for $1.23. It was up more a little bit earlier today. Seems like the markets are going against me since we've started the show. And the VIX trade. Okay. So we got this done for 75 cents. We're up 50 cents on this trade. We put it on Monday. We're now trading 50 cents higher on the trade. But where we want to pay attention, and for some reason, I mentioned this on Monday too, my source for futures quotes in the VIX index is usually to go to the CBO. Just type in into Google CBOE delayed VIX quotes, and that will give you the futures quotes. But they're still having an issue with the site, and I'm not seeing that futures quote. So we have to go back and manufacture that quote. And we did it on Monday's show. And I also mentioned, and I think there's been a few people that have checked it out, an article about trading VIX options that's in my x.com profile called Decoding the VIX. So if you want to look for that, it's not that far down the chain. There's an article on the VIX. If a lot of these things that I'm saying are Greek to you, using that pun for the option trading pricing thing. See what I did there? All right. So here we are. VIX is at 1861. Was up a little bit this morning, but now it's gone down a little bit. So that must mean the SPX is probably going north. Yep. It's up just a fraction, almost flat today. And when the VIX is down here, this is where we're at. VVIX is down a little bit too. That doesn't hurt our trade, that the volatility in the VVIX, which is the VIX of the VIX, the volatility of the options in the VIX index. Okay. So now here's where we're at. In order to figure out approximately where the future is trading, you want to see where the call and the put flip. So the 20 strike is trading 230 on the asking price for the call. The 21 strike on the put is trading at 193. And so if we go back to this one, okay, so we're trading on the ask at 189 on 22. So we're right around 21, actually. The asking price on, so what I'm looking for is where the call and the put are trading almost at the same price. So the call is trading at 189 at 21. And over here, it's trading 193, 255. 255. But if I look at the 20, and the market's really moving fast. It was 189. There we go, 180. So it's somewhere between 20 and 21. I would say based off of these numbers that it's about 20.50. 20.5 is about where the future's at. And that translates to our butterfly trading at about $1.27. All right. So what do we do with our trade? We have the trade on. It's a 1 by 2 by 1. If we did a 5 lot, may we take some profits? It's a tough call. I think I would ride this trade and let it run, but the VIX is really just a feeling index. You can kind of look at the charts to try to do some technical analysis, support and resistance. It's a mean reverting index, which means it usually wants to come back down to where it was. And that was down around the 17 level. But at this point in time, I would probably just keep the trade on and we'd let it ride. The VIX futures contract being at 20.5. We got a long ways to go to that expiration date in the VIX world. We have 21 days remaining. And let's go look at the what if calculator. And we see here that this is where the spot is at, which is the actual VIX index, 1937. But we're trading legitly right about right here. Okay, so this is where the VIX gets confusing, right? Because the futures contract is driving the price of our option contracts, not where the spot is. Now, eventually, the market will start going down and coming in line with the spot, but that's closer to expiration. We still have a lot of days left. So the marketplace is anticipating more volatility going into the October 16th expiration than what we're seeing right now. Now, if we see the futures contract get up towards the 22, 23 is the perfect scenario, right? In other words, the way that I would kind of look at this trade is I would put in an order right now to sell at double. So this would be 150. We paid 75 for it, and I would make this a good till canceled order, and I would send that to the trading floor. I would flip the script, say we're going to sell, this is going to be a buy, and this is going to be a sell. And we're going to try to do this for a 150 net credit to the account, and we're going to do a good till canceled. And if I could get 25 more cents out of this trade, and it happened today, I'd be very happy with that. If we were closer to expiration, the trade would increase. It would help us out. If you're within your strikes and you have time decay as your friend, in butterflies, that's a good thing. You want implied volatility to go down if you're correct on your forecast, because you've sold, you want that to go down, and you want options to decay because you've sold 2 option contracts. And if you are correct on your forecast, that means they're going to be at the money option contracts. You've got to close those. You want them trading for as little as possible. That happens closer to expiration or if implied volatility comes in on the trade. So if I can sell this for $2, that's great. The maximum upside of the trade is the difference between the strikes. So that's $4. Well, 18 would be $5. We did the 18 strike here. So the maximum is $5. But I've said this many, many times. When you're doing butterflies, don't ever think that you're going to get the maximum. And if you do, you should also get the stupid award because you should have been out of the trade earlier. It's just that simple, that straightforward. If you get you approach this trade, you have little risk. You've managed your risk by putting it on. If you double or triple on the trade, you want to get out. Don't even pay attention to what the maximum is. If you have a large position on 10, 15 contracts, all right, you want to let a couple ride to see if you land right on, if you're perfect at predicting where the VIX is going to land on the October 16th expiration, well, then go for it. I don't mind that. But if I'm just trading a 1 lot here and in a vacuum, if I double on the trade, I'm going to think about getting out. And I may lean into this one a little bit and say, well, I want to get $2 on the trade. And that's the way that I would approach it. All right. So do we have any questions? Let me check. No questions. All right. That's going to be it for this edition of Options Guide TV. Fun week. Got a couple more fun trades to look at. Oh, by the way, DHI is just kind of hanging around. We talked about that one on Monday, but that's a long-term position. I expect volatility in the housing market. Interest rates are going to come. If the Fed keeps doing what they're doing, interest rates are going to go lower, and that will eventually help mortgage rates, which eventually should help home builders. They've really held their own through all the interest rate hikes, and they're still trading at solid valuations. So DHI, we probably won't talk about it again for a while. If it did come down and hit our long strike, we would get out of the trade. But at this point in time, we're just going to keep our deep in the money option contract and let it ride. Our expiration is the third Friday in May. Thanks for stopping in. Please share Options Guide TV with your friends, family, everybody. It's free for all. Check it out inside the Tradier Hub. Thanks, Tradier, for sponsoring the show and putting this all together. And check me out on x.com. My handle is @BrianOverby. Look for that VIX article, and we'll see you this Friday, 11 a.m. for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.